Hello and welcome to the Margin of Sanity podcast. Today I want to talk about money market funds, how they work, how they're regulated, and how safe they really are. I am very interested in this topic as I have all my cash always invested in these financial instruments, and I'm sure many of you do as well. So why are they so safe? What would have to happen to make them unsafe? Just a reminder, this write-up is available along with a bunch of other write-ups totally free on the Margin of Sanity Substack. If you enjoy listening on Spotify or Apple, please give this episode a like or a 5-star review or drop a comment and say hello. That really helps people find the show, and it helps me explain to my girlfriend why I'm too busy to come grocery shopping with her. All right, money market funds. Let's get into it. I don't have a savings account. Not a traditional one, anyway. As someone with no debt or dependents, I don't really feel I need an overly large pool of savings. And so I keep my savings invested in a Schwab money market fund, in a separate brokerage account. That way, my returns and my personal finance choices are separate. I know some banks offer high-yield savings accounts, and those often have competitive-ish interest rates with the money market funds. But for me, money market funds are more simple and effective. I don't need another financial institution in my life, especially a name I don't recognize and trust. This MMF may ultimately get me an extra 1% of interest over my life, and I'm good with that. There's a bit of difference, however, between money market funds, not to be confused with money market accounts, and traditional savings accounts. That is the FDIC. See, in a savings account in the US, as many of you already know, my money is secured by the Federal Deposit Insurance Corporation, FDIC. This means that I'm insured against bank failure for up to $250,000, well above the amount I would likely ever have in a savings account. Money market funds don't offer this same sort of crisis guarantee. SIPC insurance does not cover the potential for breaking the buck in a money market fund. But let's back up. How do money market funds work? Well, when I buy $1,000 of a money market fund, I'm basically buying into a mutual fund which invests my money in very short-term debt instruments, usually T-bills, repos, and commercial paper. With my Schwab money market fund, it takes 24 hours to clear into actual usable cash. The reason being that the fund needs time to actually go and buy or sell $1,000 worth of short-term assets. Why short-term? Well, imagine you own a 30-year T-bill at 4% and rates climb to 8% over that period. Well, you would be in the red for the entire ownership period until your bond matures in 30 years. Of course, once that bond matures, you are made whole with your 4% annual interest on top of it. But if you wanted to sell that bond early, you would end up selling for a loss or having to wait the 30 years for the bond to mature. 30 years is a long time. 30 days, on the other hand, is a pretty reasonable amount of time to wait, and so short-term debt instruments don't carry the same sort of interest rate risk that long-term bonds do. Of course, you also don't get very much upside either if rates move down instead of up. You could theoretically create your own money market fund and actively buy and sell short-term debt instruments, or you could just let Schwab or Fidelity do it for you. This constant turnover of assets means there's always a lot of cash in the fund. As these less than 1 year long debt instruments mature, they are turned into cash. And that 24-hour waiting period helps to ensure the fund has a bit of a grace period to meet the cash needs of investors. If a lot of investors want out tomorrow, mountains of cash are already scheduled to arrive tomorrow or next week. Moreover, the assets themselves are very low risk, with both short maturity periods as well as the underlying contracts themselves being AAA rated. It should be noted that the term AAA is reserved for longer-term debt securities, and the equivalent for ultra-short-term assets, like the ones held in money market funds, 97% of holdings are super short-term, is called A1 or P1. A1 is S&P, and P1 is Moody's. Government regulation dictates that 97% of a money market fund's assets must be in these Tier 1 securities. Moreover, the regulation requires that no money market fund can hold more than 5% of a non-government issuer's paper. The fund can't be 20% in JP Morgan short-term debt. Otherwise, a single issuer, be it Apple or Enron, could really break the buck. So there's built-in diversification here as well. except for the US government, of course. But we'll get to that later. Breaking the buck. I've used the term breaking the buck here, and I should explain. When I buy $1,000 of my Schwab money market, I have $1,000 in value, always redeemable for that amount. $1 equals $1. Something going horribly wrong with a money market would result in breaking the buck, meaning $1 equals, 99.5 cents or less. This is a big deal for a money market fund. Back in 2008, there was a fund that broke the buck, and it wasn't Schwab, as they constantly point out. Back in September of 2008, the Reserve Primary Fund was the world's third largest money market fund with roughly $62 billion in assets. It also happened to hold about $785 million of Lehman Brothers commercial paper. When Lehman filed for bankruptcy on September 15th, the paper became effectively worthless, slicing the fund's net asset value to 97 cents a share. $1 equals 97 cents on September 16th. This disaster resulted in the Reserve Primary Fund becoming the first large U.S. money market fund to break the buck. Panicked investors demanded nearly $40 billion in redemptions within 2 days, forcing the fund to freeze withdrawals and enter liquidation. The episode spurred the U.S. Treasury to issue a temporary guarantee for all money market funds to avoid a run, and led the SEC to tighten Rule 2A-7, establishing the modern liquidity, maturity, and disclosure rules that govern funds like SWVXX today. SWVXX is the Schwab money market fund I keep my cash in. Had the Treasury not stepped in, I'm not so sure Schwab could boast as it does about their record. Now, in the end, investors of the fund ended up receiving about $991 for every $1,000 invested in the fund. That doesn't sound so bad, right? The problem, and I can't emphasize this enough, was that investors did not receive that money until 2010, 2 years later. That is a bit terrifying if it's 2009 and you've lost your job and your stocks are all in the toilet. It should be noted that after this disaster, the rules for money markets did get tighter. The SEC rewrote Rule 2A-7 in 3 big waves. Firstly, and most importantly, I'd say, in 2010, the SEC tightened the fund's plumbing, slashing maximum average maturity to 60 days, capping any single holding at 397 days, and requiring every money market fund to keep at least 10% of assets in cash-like securities that convert to cash overnight, and 30% within a week. They also insisted on monthly portfolio disclosures and stress testing mandates. Next, in 2014, the SEC went after run risk. In other words, institutional prime and municipal funds had to float their share price instead of rounding to $1, while all non-government funds gained the power, and if liquidity fell too low, the requirement, to impose liquidity fees or temporary redemption gates. Here's Margot Robbie to explain. Just kidding, it's still me. Picture a money market fund like a communal cookie jar. Before 2014, every jar was labeled $1 per cookie, no matter what the ingredients inside were worth that day. So if people worried the cookies might suddenly shrink, the fastest grabbers could empty the jar first and walk away with full-sized cookies, leaving the latecomers with crumbs. You probably know this phenomena as a run. The 2014 rule change fixed 2 things. 1, jars meant for big, sophisticated investors that hold corporate IOUs, so-called institutional prime and municipal funds, now have to show the real cookie size each day. Maybe it's $0.0003, or maybe it's 0.99997, whatever. But what this accomplishes is that those investors can already see tiny ups and downs and feel less pressure to stage a stampede. After all, people's fears are usually far greater than reality. I think the idea is that transparency would keep everyone's blood pressure lower. 2, any non-government jar, whether for folks like me or for institutions, is now allowed or even required, if liquidity drops below a certain point, to put up a small toll gate, a 1 to 2% withdrawal fee, or briefly close the lid for up to 10 days. That pause gives the baker some time to restock instead of dumping cookies at fire sale prices. Government funds and retail prime funds keep the fixed $1 label, but the threat of a toll gate still hangs there as a brake on panic. In short, this second rule change is like adding banana peels to a bank run. It's meant to slow, stop, or avoid one entirely. Finally, in 2003, the SEC decided that money market funds needed fatter cash cushions and fewer panic buttons. After all, too many panic buttons can make people panic. As a result, it more than doubled the ready cash pile every fund must keep from 10% to 25% that can be turned into cash overnight, and from 30% to 50% that can be cashed out within a week. That way, if lots of investors want their money back at once, the fund already has half its assets sitting in near cash form. At the same time, the agency took away the redemption gates that lets funds freeze withdrawals, since even the threat of a lockdown made nervous investors run even faster. Instead, when it comes to big institutional prime and tax-exempt funds, the ones most prone to runs, the SEC now automatically charges a small exit toll if redemptions in a single day top 5% of the fund. That fee lands on the investors who are rushing for the door, not the ones who stay put. Retail and government funds still keep their $1 price and don't face that mandatory fee, but they benefit from the thicker liquidity buffers and the fact that no fund can lock anyone in anymore. Now, I actually get a good deal of comfort from these rule changes. They make a lot of sense, and they put the burden and the cost of staying calm on large institutions and not average folks. So let's talk about risk. How to break the buck. Okay, so now you understand what they are, how they work, and how they're regulated. Maybe we can try and imagine how to destroy a money market fund. Rather than ask ourselves, what are the risks of a money market fund, I think it's more fun to try and concoct a perfect storm, as if it was designed to destroy my savings. Big surprise, the answer is basically just recreate 2008. For this hypothetical catastrophe, I'll try and use the Schwab Prime Advantage Money Market Fund, SWVXX, the one that I'm invested in. The setup for this would be some new sort of financial crisis in which both the equity and the bond markets are panicked and credit defaults begin rising. Step 1. Credit shock. 5% is the maximum amount a money market can hold of a non-government institution's debt. If a major issuer, for example, a large bank or corporate, unexpectedly fails, SWVXX would incur losses on those holdings. Even a few basis points of realized loss on SWVXX's roughly $240 billion portfolio would erode its cushion. Step 2. Breaking the buck Part 1. As the shock materializes, SWVXX's portfolio must be marked down. Its market-based net asset value, a daily calculated price, would slip below $1, for example, to 0.999 cents, even though the official share price remains $1 by rule. Under today's rules, MMFs report portfolio info daily, so investors quickly see that SWVXX's market value is impaired. This triggers alarms. The media might have a field day reporting that SWVXX can no longer perfectly preserve $1. In practice, seeing any net asset value shortfall, even tenths of a cent, scares investors. Remember the reserve primary fund? Those Lehman losses showed how a tiny net asset value gap can instigate massive redemptions. For SWVXX specifically, a below $1 market net asset value means its promised stability is broken in the eyes of investors, prompting the next phase. Step 3. The run begins. In a panic, SWVXX shareholders, mostly individual retail investors, rush to redeem. In the 2020 COVID crisis, retail prime outflows reached 9% of assets versus only 4% in 2008. With news of SWVXX's mark value below $1, everyday investors are more likely to run on a fund, fearing loss of principal. Critically, modern SEC reforms forbid any gate to suspend redemptions. Ever since 2023 and 2024, SWVXX cannot stop or slow redemptions for these funds. It must pay every investor at $1 per share instantly, no questions. SWVXX currently holds 25% of its assets in ultra-liquid cash and government instruments, and 55% can be liquidated within a week, above the 50% regulatory minimum. But even a moderate outflow, 10 to 15% of assets, would quickly exhaust the 25% daily buffer. Because SWVXX has no mandatory liquidity fee, that applies only to institutional prime funds, and only a discretionary fee for retail, none is triggered automatically. The run thus accelerates all at once. Investors redeem $1 per share, forcing the fund to liquidate assets to pay out. Step 4. Forced liquidation. Now that the run has begun and the cash cushion is depleted, the fund must begin selling assets to meet its withdrawal requirements. To meet redemption beyond its cash buffer, SWVXX must sell securities. First, weekly liquid assets, repos or short T-bills, then its remaining private paper. In a severe stress, these sales happen at depressed prices. This, of course, would turn the paper losses into real losses. Step 5. Breaking the buck, Part 2. Those realized losses drag the fund's true net asset value below $1, with no way to keep rounding up. The share price slips under $1, and investors still inside the fund now own less than they put in permanently. While initially, in Part 1, this was a theoretical market move which broke or maybe just bent the buck. Now there is literally not enough money in the fund to ever return to a one-to-one with investor dollars. Step 6. Cleanup. The board and regulators step in. The fund either converts to a floating net asset value or winds down and returns what's left to shareholders. Shareholders eventually get most of their money back, but a few pennies per dollar are gone, and access to the cash wasn't instant. I'm doubtful we would have yet another 2-year waiting period for redemptions, but then again, in a situation like this, something much crazier is likely happening in the financial system. And so regulators are busy putting out fires everywhere. Okay, so that's pretty much just what happened in 2008. It might sound bad and somewhat plausible, but there are a few important notes to make right now. Here's a couple reasons not to worry. Sponsor bailout, and this is a biggie. Fund advisors have stepped in hundreds of times. Moody's counted 62 sponsor bailouts in 2007 and 2008 alone, to top up losses and keep the $1 peg. Schwab isn't legally obligated to do so, but its brand and the rest of its $240 billion in cash management franchise give it a powerful incentive. In short, they spent a good deal of money back in 2007 to be able to tell me 15 years later that their fund has never broken the buck. And that's pretty cool. There's also less reason to run. SWVXX now holds at least 25% of assets in overnight cash, and 50% in securities that turn into cash within a week. If investors stay calm, those buffers easily cover normal redemptions while the managers work out the loss. Breaking the buck in a permanent way isn't inevitable at all. One glaring hole. Okay, my final doom test. If you hadn't noticed, there is a built-in assumption that U.S. government bonds are at a near zero risk of default. As a matter of fact, regardless of what S&P and Moody's says, legally, these treasury bills are designated as Tier 1. Essentially, the government made it a law that their debt is as good as gold. Does that mean it always will be? Not necessarily. Now, I abhor the U.S. debt burden. If there was a real pay off the debt political party, I would be the first to sign up. That said, I don't think that means fear-mongering about the debt is going to improve either of our returns. So I want to take a look at what would happen if the Treasury actually missed a payment, i.e. defaulted on the debt. No surprise, it's really bad. Okay, every year the US government plays a game of chicken with our debt ceiling. Perhaps it's all theater, but let's say someone takes it too far and the US actually misses a debt payment of, say, $100 billion. Enter the world of technical default. Treasury misses the payment, and those T-bills automatically default. A missed payment turns that bill from risk-free cash into a defaulted security. Prime funds like SWVXX and Treasury-only funds that hold near-dated bills must now mark them down sharply. Government securities lose their automatic first-tier status once they are in default. Traders, seeing this, naturally flee like the devil from any near-dated Treasury bills. Yields jump 100 to 300 basis points, as they briefly did during the 2011 and 2013 standoffs, when some bills cheapened by 66 basis points in a single day. Government MMFs are 99% in T-bills and repos, collateralized by T-bills. Even a 1% drop on half the portfolio shaves half a cent off their $1 net asset value, enough to break the buck. Prime funds use bills for liquidity, so they too take immediate mark-to-market hits. Then the repo market kicks into gear. Because so many repos are collateralized with T-bills, counterparties demand huge haircuts or refuse the collateral altogether. The Fed warned in 2013 memos that a default could compromise the functioning of the repo market. MMFs rely on overnight repos both as assets and as ready cash. If repo liquidity vanishes, funds cannot roll expiring repos into new ones, draining their 25% overnight cash buffer overnight, just as investors are starting to redeem. Investors in money market funds like me would naturally freak the fuck out. Headlines about a defaulted bill and frozen repo market trigger redemptions. With no redemption gates allowed under those 2023 rules, every fund must pay out immediately. To raise cash, funds dump still good bills into a market with no buyers, locking in bigger losses. A government fund can't impose an automatic liquidity fee. That tool is only for institutional prime and municipal funds. So the $1 net asset value cracks. Now, this is where the Fed should step in. If they didn't, it would be pretty painful. But with these sorts of assets, we're still only talking about a maximum 12% loss. Still quite a loss on something regarded as risk-free. I think it should be noted that this is quite a special situation. It would require a lot of things to go very wrong altogether. The government isn't perhaps the most competent entity on Earth, but they are aware of the systemic risks of missed debt payments. Moreover, the Fed has a long history of stepping in to shore these things up. Not only that, but the market knows the Fed has done that historically. I believe it was Treasury Secretary Hank Paulson who said, "If you've got a bazooka and people know you've got it, you may not have to take it out." Honestly, I'm not worried. I know it's probably the sexy thing to kind of fearmonger about money markets and whatnot, but let's be real. The events that must take place in order for an individual retail investor to really feel pain in MMFs are once-in-a-century events. Those events already happened in 2007 and 2008. In my mind, my risk is near zero. If I had children or higher monthly costs, I might have a different personal finance arrangement and one that would likely involve the FDIC. Realistically, there is just nothing wrong with having savings in a high-yield savings account. That's what they're for. I'm not against that even a little bit. My hope was just to truly, once and for all, get my head around the actual risks to my cash. The word on the street is that money market funds are perfectly safe, but that sort of hearsay is perfectly useless to me. I want to know why. Thanks for listening to the Margin of Sanity podcast. Just a reminder, this entire write-up is available totally free on the Margin of Sanity Substack. Thanks for listening, and I'll talk to you later.